Hey, what's up, guys? Mike Sharp here again. This is a different type of episode. I'm going to talk about Warren Buffett's shareholder meetings. Now, I got the idea I could listen to these on hikes. I go on hikes quite often, bike rides and stuff like that. I'm like, oh, I could listen to this instead of listening to stupid macro podcasts, and I might actually get something useful out of them. I studied Buffett years ago, but I think it's always good to go over his stuff. And I just thought I wanted to pull out some of the nuggets that I got from these shareholder meetings, and I'm just going to spit them out into the camera here. And because I think that helps it solidify in my mind, like just listening or just reading, a lot of the time the information falls out. So yeah, that's also why I do these videos, because if I explain it to you, if I'm able to explain it to you, then it means I understand it. So if these are useful, then maybe hit the thumbs up button. If they're not, I'll kind of get the idea, but I may just do these as I listen to them. So this is from 1994. There was a lot of talk about Guinness and some of the companies he owned, very specific questions about that time period. So I've ignored a lot of that stuff. But one of the nuggets that popped out to me was somebody was asking about, does he hedge his exposure to foreign companies, right? So does he use currency hedges? If not, why not? And basically they said that they don't use them. And the reason they don't use them is because, the way that Buffett looks at his companies that he owns is it's essentially like a bond with an unknown coupon, right? So let's say you own Guinness, and every year you get earnings from that business. Well, we don't get earnings, but they collect earnings. And then, so if you're going to hedge all those cash flows, basically you have this perpetual hedge that you have to put on. It costs you money. And, I think that he thinks that that's more kind of trouble than it's worth and more expensive than the value they get from it. The more interesting bit that I found was he said, well, we don't know more than the market about currency, so we don't have an edge there, so we don't do it. And that's really in line with his thinking, whereas he just sticks to his knitting. He knows where his edge is. He knows what his circle of competence is, and he sticks to it. And he's saying we don't have an edge, so why would we put that mental energy into that? So the next one is, you can't make money with a weather vane. I think somebody was asking about some article in a magazine, and he says, well, basically, if you're taking all these other people's opinions and trying to make money off that, basically you don't know what you're doing, right? So I guess my extrapolation on that is, if I find myself agreeing 100% with anybody, right? Like let's say it's an analyst, or let's say it's even Buffett, right? Or a political party, just to take it out of the investing realm. If I'm agreeing with 100% of what that person or that group of people says, it means I'm not thinking. I'm not thinking for myself. I'm just taking information from them and regurgitating it and saying it's my own thought. But the problem with investing and doing that is, if the positions go against you, there's no foundation to rely on. Like if you're watching, let's say you're watching my videos on whatever and waiting for my opinion on them, you're kind of like in a boat without a paddle, right? You have to develop your own vision of what that company is and what they do and why you're buying it, so that because almost every position I've ever had, and every position that I think that you've probably ever had or you're going to have, is going to go against you at some point. And you're going to need to have your own thinking to fall back on when that happens, so you feel okay when the position goes against you. Like Stoneco, it's down like a third from the top now, and so you say, okay, what do I actually think of this? Which is what I said in my last video. Next one is, so in relation to DCF, again, if you're getting any value from this, just hit like, so I know that people want to see these. If nobody wants to see them, then I won't bother. But or maybe I'll just do them anyway for myself. So next one is about DCFs, present cash flow. So the value of a business is the discounted cash discounted value of all future cash flows discounted at an appropriate rate to the current to a current present value. And so part of that means you have to actually figure out what the future cash flows are, right? And Buffett says if you don't have the faintest idea what the future cash flows are, you are, what did he say? You will not know what the company's worth today, and you probably have cognitive dissonance. I have trouble saying that. So he goes on to say that, and I think this is one of the more lost concepts that Buffett talks about a lot, but I don't think a lot of people grab onto it because it's quite off-putting actually when you're buying stocks, because he basically says he values the certainty of the future cash flows over the cheapness, right? So he's more interested in knowing what's coming in terms of earnings than the actual, the relative low price of the stock, right? And that's really hard. Like, it's really hard. Like, pick any company, right? Like if I take, what do I own? Flow traders. So I have no idea what they're going to make next year. I don't have any idea what they're going to make next quarter, right? And for somebody like Buffett, that would just be, right out. I'm not interested, right? Because there's no clarity on, let alone 5 years from now, right? So that he would be totally not interested in a stock like that, or even like StoneCo, right? The management is saying these are our targets, what we're working off in 2027, and if that at least we have some guideposts there. But he's also interested. I think Buffett's interested in longer than that, 5 years, 10 years out, and that's why he ends up with companies like Coca-Cola, Apple, right? Like if you take Apple, I don't know what they're going to make. I'm sure if I spent a few hours studying Apple, I could have a pretty good guess of the number of iPhones that they may sell in about 5 years, right? Because Apple is built on this moat of retaining the people who use their products and reselling to them, right? Reselling new products or upgrading their phones or replacing their phones and stuff like that. So there's a very clear sort of revenue path. Maybe some of the stuff like their VR, we don't really know, so we could leave that out. But it's much clearer what Apple will probably be producing in 5, maybe even 10 years than it is for, I think, anything that I own, right? And Coca-Cola, pretty, a lot easier, right? So he really stressed that the certainty of future cash flows is really important to him. So if we go back to the discounted cash flow, there's a risk in a discounted cash flow. This is my analysis on this, and so totally ignore this is the the less valuable part of this thing. Like the Buffett concept is valuable. My stuff, you can throw it away if you want. But the idea is, if I'm doing a discounted cash flow on Excel, and I'm putting numbers in and saying, well, a 5% growth rate is a reasonable growth rate, or 10 or 8 or whatever I'm using, and I'm putting those in, what's happening is I'm taking random numbers out of the air, but they're making me feel more certain, right? That is dangerous, because I actually feel like I have something to lean on and I'm more confident in it, but I've actually just put, just BS into this sheet. It's just made up numbers, right? So if I take I'm going to put up my StoneCo valuation here. If we look at the first one I did, I posted this a long time ago. If you look at this, my targets here where the margins were going to be up to 30% by 2024, they're not at 30%, right? My revenue target, it's looking like, about 15 billion this year. That's not bad, right? But my margin estimate's way off. And, I was expecting 4.5 billion in EBT this year, which is their target for 2027 now. So this discounted cash flow I just did 2 years ago is totally worthless now. It's like, and it's, I've talked about this before. I actually don't do discounted cash flows because of this exact reason. Like, it's just, it gives me false confidence, right? So that's just a word of warning, right? And, and that's why I think why Buffett really, he doesn't buy that many things, right? Because it takes him so long to really understand what this company is and what they're doing, so that he can forecast. Well, he doesn't even do DCFs actually, but he can forecast them in his head and say, this is what I think they're going to do, because he knows the company's inside out, right? Like if I was going to do a revenue and profit projection for my private business, I would have a lot more confidence in that, being able to see what the next 5 years look like, because I know the company inside out. I know what the possibilities are. I know what the margins are. I know everything about it, right? But I don't know that much about any stock that I own. And I think Buffett does understand a lot of his companies to that level, or at least close. So next one, the last one here, is just a short one. Everyone talks about Buffett. He likes the return on capital, right? And so he said there's a huge difference between a company that needs a lot of capital to grow and one that needs a lot less. And so, I guess we can all come up with a lot of ideas there. Anything where you're building a storefront or you're manufacturing some goods, that's going to take a lot of capital, and you better have a very good brand or some other kind of moat so you can price it very high, right? Like if you're, like Apple, right? They do have a moat so they can produce their goods and make good margins on it. But it's very hard to do that when you're actually building products and making products. So technology companies are the big example of a very high return on capital business. Now, I would maybe argue that return on capital for those types of businesses is not actually a good metric, because the limiting factor with growth is not actually the property, plant, machinery, anything like that. It is the limiting factor in something like a shoe company, right? You need to actually build the facilities to actually to fulfill the growth, whereas a technology company is more, you just need the people, right? So I think my view is I would look more at profit margins, because that's the return on the expense, the people expense that you're spending on. But Buffett does have it right. If and you're in any kind of business where you're creating or building something, or making something or like that, a high return on capital is a major advantage, and it's a sign of a very, very good business. All right, that's the end. That's just me spitting out after listening to the 1994 shareholders meetings. I'm going to go forward. I'm in the middle of 1995 now, and if you get something from this, great. If not, let me know how I could make it better. I'll catch you in the next video.